Okay, so I'm going to record. And are you in now, Anisha? You're in. There you go.
Okay.
All right. So let me head on over to the actual presentation. Hold on.
Okay, can you hear me?
Yes, I can.
Okay.
So everybody is in, right? Vicky
Yeah.
and Anisha. Okay, all right. Well, it's too bad my nephew couldn't make it. Because he's my number one reason for doing this, but that's okay. He's working. If you got to work, you got to work. I am going to record this, okay? Because I'm recording it also for my nieces who are working. One of them is working at the hospital. She's a respiratory technologist. She saved a lot of people during COVID, I'll tell you. Okay, so you can see my screen, both of you?
I see absolutely nothing right now. Only thing I don't see anything.
How about Vicky? Vicky, can you see my screen?
No, I can't see anything now either.
Really? Okay, hold on. I know what it is.
You hit the shared
I'm going to
content.
share screen. Hold on. I'm going to just share screen. Hold on. Share screen. I haven't done this for a while. Share. You should be able to see it now.
Yeah, I see it now. Yes.
Okay.
Yes.
Good. All right. So welcome, Vicky and Anisha. So today we're going to talk about investing your money wisely. And the reason why I'm doing this is really because many people in our community live day to day as far as their earnings and cash is concerned. A lot of people spend all their money, and they do not invest anything. And I would really like to change that, especially in our community, because we really need to think about generational wealth. Okay, so tonight I want to talk about the different types or methods in which we can save for our future, right? Now, I am trying my best not to use the word retirement, because when you use the word retirement, the younger ones say, boy, this is not for me, right? Because they're thinking of a person who is old and, therefore we don't really get them. So I always say, investing for your future. Okay, so the types of investment that we have, some people see investing or just use their savings account as a way of investing or saving their money. Just a saving, some people invest their money in a checking account, if you believe that, right? Some people use certificates of deposit, which they call CDs, and some people use GICs, guaranteed investment certificates. There's also mutual funds. There is something called ETF, which is exchange traded funds. There are stocks. I'm sure you guys have heard about stocks, the stock market, right? Feel free to interact with me because it's just the three of us. That's cool. Okay. Real estate is also another very, very exciting way of investing. It's actually one of the best. And right now, I'm going to tell my husband to shut up because I'm having a meeting. Sorry about that. Right? Real estate is the one I love the most. And it's the one that most of our people in the Black community are not invested in. And they really need to understand that. A lot of people are afraid of it. And it's not just Black people. A lot of people generally are afraid of the commitment of real estate, but is the most lucrative investment ever. Okay? And then we have other types of cash flow investments. Now, most people think when they think about investing or when they get their paycheck, they just spend it and wait for the next paycheck and they spend it, some go into overdraft every month, right? They never think of saving something for themselves. I think the Wealthy Barber teaches that you should try and save at least 10% of what you earn every month, right? Most people pay their bills before they think of saving. Now, let's talk about a savings account. So this is an investor right? Because I know a lot of people when, I started in banking in 1979. I remember this old lady, she had like $20,000 sitting in her checking account, wanted to save up enough to buy a house in Toronto. And, 10 years later, she still had, like 23,000 saved when she could have bought a house. But she wanted to save up enough. She wanted to buy a house cash. Never happened for her, right? So the person who saves their money in a savings account, this investor lives day to day and does not care about having more money in the future, right? Because if they did care, they will learn about different types of investment vehicles. So they live
Mm-hmm.
paycheck to paycheck. They have no knowledge of how to invest his or her money. They usually regret not learning more in their younger days later on. Because, I remember doing a session for about 1,000 people in the church, community. And a lot of them, when I was finished, said, Jean, oh my God, where were you 30 years ago? I wish I knew all this, right?
Mm-hmm.
Now, when you look at a savings account, well, where I am in Canada, if you were to put, money into a savings account, you're earning 0.01%, if that much. It's pathetic, right? So if you have $10,000 and you put it in a savings account, you're going to earn a buck over, a period of 1 year, right?
Mm-hmm.
That's just not acceptable, is it? Right? So
No, it's not.
how much exactly? How much do you earn on a savings account, right? Now, Bank of America, because I was speaking with Americans tonight, Bank of America pays 0.01% per year, right? Now, because rates have increased over the last 12 to 24 months, some people are making a little bit more, but it's still not good enough, right? So you, the investor, you're making $1 on your $10,000 investment that you have sitting in this savings account, mine in the massa, mine in the man, right? And the bank is investing that $10,000 and they're earning a lot more because they're investing this money in you know, mortgages, investments, people are borrowing money to build skyscrapers, right? So they're
Mm-hmm.
using your money, they're paying you $1 and they're making like $720 a year or more, right? Because some banks will give you a visa, right? And a visa, how much are you paying? 19.9%, right? If you were to go to a store card, some of those are charging 29.9% per year. So do you see the discrepancy? Do you see how much money financial institutions make on us? And we are there putting our money in the bank at 0.01, percent. It's criminal almost, right?
Yeah.
So
Yeah, it is.
there
It
are
is.
some clients who ask themselves sometimes, hey, I'm tired of earning this 0.1% interest rate. Why don't I? And they go into the bank and they say, hey, what can I do to earn more money? And they'll say, well, Mrs. Smith, there is a certificate of deposit that you can invest in, or you can invest in a GIC, right? So what are those? Those are usually money invested for 1 to 5 years, right? You can invest for a longer period of time, but places like Canada, if you invest over 5 years, the government will not guarantee your funds, right? In Canada, we have something called CDIC, which will guarantee your money up to $100,000. So if the bank fails, they'll pay you back. They have something similar in the US. I can't remember what it is, but it's insurance on your money when it's in the bank, right?
Right. Right.
You get a set rate of return for a predetermined period of time. So if you invest for 1 year, say you invest $10,000 at 5%, you get $500 for a year, right? So the
Mm-hmm.
average rate at most banks right now is about 1.7%. So for the last 15 years, rates have been much lower. It's just in the last couple of years, guys, that rates have really gone up a little bit. Okay, so keep that in mind. Now, let's go to the more fun stuff, mutual funds. Now,
Mm-hmm.
a mutual fund is a pool of money managed by a professional fund manager. So if you were to go into Bank of America, TD, Invest, Ameritrade, or any one of those companies, a lot of them have investment portfolios in mutual funds, right? So the bank will collect money from a number of investors who then pool their money and invest it. So a mutual fund is a portfolio of stocks. So, and those stocks represent companies, right? A mutual fund could have stocks of 500 companies in it, could be more, right? A mutual fund could be investing in certain geographical locations such as China, South America, Canada, the US, right? So they would invest in certain geographical regions, right? Now, a mutual fund could also invest in technology companies, healthcare, transportation, airlines, entertainment, cruise ships, right? So they have all kinds of mutual funds that invest in different industries, right? So many people are scared to invest in mutual funds because they do not understand it. So to understand mutual funds, you must understand the word risk, right?
Mm.
Now, when you mention risk to people, they shiver, right? Oh, I don't want to take any risk. But you know
Mhm.
what risk? You know what's risk?
Yeah.
Worst risk is this here. Putting your money in a bank account, paying you nothing, and the banks make using your money, making all kinds of, returns, right? And not giving you anything. It's slavery, really. So when you invest your money in a mutual fund, you must be able to handle market fluctuations. And we're going to talk about that. Okay.
Mhm.
So this is a fluctuation of the price
Yes.
of a stock. Price fluctuations make a lot of people uncomfortable. But I'm going to, by the end of this session tonight, you're going to be much more comfortable with it. So what is price fluctuation? It is movement in price of a product depending on supply and demand. For example, what happened to the price of eggs during COVID? What happened?
The prices went up
Price of eggs went up
Oh, amazing. People were pissed, right?
dramatically.
Like you were looking at $8 for eggs and people were swearing, right? They didn't
Mhm.
like it at all.
It's still expensive. They're still around the same price, even more.
Yeah, there you go. Yeah, I mean, you have to go from store to store to get a box for $4. Right? Go to Aldi's or something. Hey, call up my friends. Aldi's has eggs for $4. So my question is, was everyone unhappy when the price of eggs increased? Who was sad and who was happy? Who was sad?
That-
Anisha, you were sad, but who was
I
happy?
was, 'cause I didn't buy eggs anymore.
There you go.
Hey,
So
you're sad, but the investors is happy.
thank you
Yeah,
very
they
much.
are.
So consumers, people who buy eggs were really sad, right?
Yeah,
Especially
yeah.
the parents with 5 kids, oh my goodness, right? Who is happy? Stock and mutual fund owners. If you owned a mutual fund in a food company, your mutual fund price will increase because food prices, including the price of eggs, have increased,
Hmm.
right?
Mhm.
For every sad person, there's three out there smiling.
Mhm.
If you own stocks in ABC Egg Company, you'll be happy because the stock price will increase because prices have gone up. So let's play. Let's create a mutual fund. Let's say, it's October 2019 and I hear from the conspiracy guys because I'm smart. I'm on Facebook and I'm reading all these conspiracy theories, and I hear that COVID is coming. So I start thinking, if they're going to lock us down, people are going to want to use FedEx to send their packages, right? They're going to want to
Uh-huh.
use,
Yeah.
yes, they're
Yep.
going to want to invest in maybe Moderna because they're going to be developing a vaccine, right? And the
Okay.
conspiracy theorists tell me, don't worry, Moderna vaccine is already done. This is a plan, right? They're gonna buy eggs,
Hmm.
right? And they're gonna want to buy bacon. So I mean I could use other companies, but we'll just stick with these for the time being because these stocks did very well. So let's look at FedEx, right? So FedEx was at $109, right? And at the peak, it was $309 during this period, right?
Oh,
So,
wow.
if you were to buy 100 of these stocks and sell them at the peak, you would have made 20 grand. Same thing with
Oh, wow.
UPS. Started out at 90, at the peak was at 225. You bought 100 of these, you would have made 13,500. Moderna started $19.52. You bought 100 of these, they went to a peak of $449. $42,000 you would have made. Eggs, $1.99 to $8. You made $600 there. Bacon, $4.49. I saw $12 in the store. You would have made $7.51, right? So that's the beauty of mutual funds. Now, let's look at the stock Home Depot. Everybody knows Home Depot, right?
Mm-hmm.
Yeah.
Now, remember March 23rd, 2020, when the markets crashed and everybody was going, oh my God, everybody was nervous, right?
Mm-hmm.
The
Mm-hmm.
price of Home Depot on March 20th, 2020 was $152.15, right? In the peak, once the market recovered, that stock went to $415 and a penny. Why do you think Home Depot stock went so high over those 2 years? Why do you think, Vicky?
Because people start like buying the product.
That's right. People were buying lumber. They were home. They were bored. They wanted to renovate their basements and, do all kind of stuff because they're bored, right? They're outside making sheds and they're buying everything. So if you were to buy that stock at the beginning of the pandemic and sell it at 450, man, you're laughing, right? Right? So if you know what's going on in the market, you can truly make good money. And that's what stocks and mutual funds are all about, right? So this chart is called an index chart. And when I was in banking, I used this chart a lot just to show people what the market was all about, right? Now, if you were to look at the red line here, that's the Toronto Stock Exchange, right? The TSX, they call it. Every stock that is listed on the Toronto Stock Exchange is represented by the pricing in this red line, right? And as you can see, it goes up, it goes down, it goes up, it goes down. But the one thing that you see is it goes up in the long term. No matter how it goes up and down, in the long term, it goes up. So if someone in 1950 invested $100 in the TSX, in 2007, that was worth about $37,000, right? And that's with all the correction. Now, if they had invested in the US small stock, which is the purple line here, that $100 will be worth $167,000. That's the beauty of having a mutual fund or a stock, guys, right? Or ETFs, which we're going to talk about. So you should never be afraid. Now, people who are afraid of risk do not understand this concept, right? Because can you imagine right where my little pointer is? Can you see this right on the purple line? I'm circling this right now. Can you see that?
Yes, I can see it.
So can you imagine if you invested here?
Yes.
You had some money and you invested, bought a stock right here at this point here, and then it just went down. That's risk. You'll be nervous and you'd probably want to jump out. But if someone taught you that the price of a stock always goes up in the long term, you wait it out until you get here, right? So you have to be able to tolerate risk. And as long as you understand that you're in it for the long term, you're not buying a stock today and cashing it out next week because you could win or you could lose, right? So when you hear of these different markets, the Dow Jones, the stock market, the Toronto Stock Exchange, the NASDAQ, which is all technology, right? This is what they're talking about. This is what they're talking about. And the green line is bonds, right? We've heard of bonds, right? Whether it's a corporate bond or a government bond, that's the green line. And their rate of return is lower. And remember, we're talking about GIC. That's the orange line here, right? See how low their rate of return is compared to a stock, right? So let me ask you a question. If you get tax return and say you get $3,000 in your tax return and you want to give your daughter $1,000 to invest, and your daughter is 18 years old, what would you advise her to invest in?
The stock,
That's right. Why?
Maybe
Because she's
the
young.
mutual. Yeah.
Yes, she's young, right? So
Mhm.
she can tolerate risk. The market fluctuations won't bother her at all. As a matter of fact, whenever you're here and the market turfs like here, right, have a really big correction, buy more because everything goes on sale. And you know why I say everything goes on sale? Because prices go down. So if you have a stock
Mhm.
that's $100 and the market goes down 50% like it did in 2008 in the US, right?
Mhm.
Instead of buying that stock for 100, you're going to be buying it for 50. So why wouldn't you want to buy, instead of 100, buy 200 and wait it out, right? So
Right.
Mhm.
that's the beauty of buying stocks and mutual funds. Now, let's talk about
Yeah.
ETF. It's called exchange traded funds. Same thing as a mutual fund, right? But in a mutual fund, you have to pay the fund manager to manage your fund. When you take your money and open a TD Ameritrade account, right? It just doesn't go into an account. It goes to a pool, and the fund manager who makes, millions a year because he works on Wall Street, right? They pay him a fee to manage that, because they know what stock is going to do well, right? So they're going to buy Home Depot and Lowe's
Mhm.
and Moderna and all those stocks to manage it for you, and they buy and sell actively to make you a return, and they will charge between 1% and 3%. But if you were to buy an ETF, it has cheaper management fees. So you'll look at management fees from 0.5 to 1%, right? So where would you put your money? In an ETF, of course, correct?
Right.
Mhm.
All right. So let's talk about the fun stuff, stocks. Now, if I were teaching my 18-year-old to invest, I wouldn't tell them to go buy a stock right away because they don't understand the stock market. You start them out with a mutual fund or ETF, and you encourage them to learn about, instead of being online gaming, encourage them to take an hour out of their, week and read up on stocks, right? Because Google is our best friend. If you go stock 101 or investing 101, you have 20,000 different links that's going to teach you what investments is all about. You know what I mean? And I
Mhm.
find our young kids spend way too much time online doing nonsense. Anyways,
Yeah.
you
They
can buy,
really do.
yeah, yeah. You can buy, you can buy a stock of any company by opening a trading account. So in the US, you can go to like TD Ameritrade. Some banks do have stock accounts as well. In Canada, all the major banks have, like I deal with RBC, and RBC has Royal Direct. So I open my stock account and I trade. I buy ETFs, I buy mutual funds, I buy stocks, right? And that's where I do it. And I do it all online. I don't have to go into the bank. So if a stock is $10 per share, you can buy 100 share for $1,000. And if that stock goes to $20 per share, you've doubled your money. You can sell it and you can make $1,000 profit, or you can buy another stock, or you can simply keep that stock. Why keep the stock
Mhm.
though? Right? Why do we keep the stock? So the advantage of holding a stock for the long term is this. Stocks pays some stocks, not all, but some of the, corporate stock will pay dividends, especially bank
Mhm.
stocks. They pay dividends, right? Like I have some
Mhm.
RBC stock and they pay 3.87%, right? Now, the good thing about the bank stock, for example, you buy it at a certain price, and over the long term, it increases in price. Sometime they will split 3 to 1. Sometimes every year you
Really?
get a dividend on that stock, right? So if you let that dividend reinvest, it's called DRIP, dividend reinvestment plan. Don't take the dividends out in cash, let it reinvest. You will be amazed, and I'm going to show you an example later on. So let's keep going. So my question was, is it good for a company to pay dividends? Of course it is, right? So typically, companies that have consistently paid dividends are some of the most stable companies over the past several decades. As a result, a company that pays out a dividend attracts investors and create demand for their stocks. Dividends are also attractive for investors looking to generate income. A lot of old people will buy stocks that pay dividends because that's how they live. Nowadays, you can't depend on the government pension plan anymore. You will never survive. A lot of our older people are struggling right now because their pension plan isn't cutting it when they have to pay $4,000 a month in a nursing home because they need care, right? So we really have to start thinking of other ways of investing our money for the long term because you don't want to be living with your in-laws because things are tough, right?
Mhm.
So I'm going to give you an example. I used to manage a bank called TD Canada Trust in
Mhm.
2001. And then after a while, it became TD. And then it went to the States, which is what you have down there, TD and TD Ameritrade, right? So I took out a loan for $2,900 and I bought a stock in 2001. Now, back in 2001, I was a single parent. I was broke. I never had extra money. Once I got my paycheck, I paid my bills. There was nothing left over, right? My first house that I bought, my mother co-signed with me because I couldn't make it. I was making like $1,100 a month, right? So I took out a loan for 2,900 and I bought TD stock, 100 TD stock, okay, because they were $29 a share. Now, I kept that stock. Now remember, I bought it in 2001 and I kept the stock until 2016, right? I
Uh-huh.
kept the stock until 2016. So that now remember, I invested $2,900 and I borrowed the money. It was a loan that I used. Guess what that stock was worth in 2016? Well over $45,000,
Oh, wow.
right? So that $2,900 that I invested in 2001, in 2016, it was worth over $45,000, right? Now, you know why? Because of dividends. Because in 2016, that stock was only worth $57. So if I had spent all my dividends and didn't reinvest it, my stock, which is worth 57.86, would only be worth 5,786 because you have to multiply it by 100. But because I bought it and I forgot about it, that 2,900 became $45,000. And guys, this is what we need to teach our young kids. We need to show them the magic of this because how many times do they blow $2,900? Right? It's
We have one
2,900.
more person on the call. We have Richard here too.
Oh, okay. So, all right. Hi, Richard.
Hey, how you doing?
I'm good. Right? So this is what the magic of buying a stock and having it compound and hold, right?
Mhm.
And
Mhm.
this is what our children need to learn.
Mhm.
Now, look at all these technology stocks, right? Now, in some mutual funds and some ETFs, if you buy a technology ETF, right? Like if you
Mhm.
look at a QQQ, which is a technology ETF in the US, right? All
Mhm.
these stocks are there. NVIDIA, you must have heard about NVIDIA. NVIDIA is amazing. It's returned 162% already in 2023. And we're in the 6th month of the year,
Oh,
right?
wow.
There's
Mhm.
Facebook, there's AMD, there's Tesla, Salesforce, GE, Royal Caribbean Cruise. Remember, the cruise companies died during COVID. So if you had taken some money and put in Royal Caribbean Cruise, oh my God, you'd make a lot of money, right? So
Mhm.
all these companies are a part of your mutual funds, are a part of your ETFs. So an ETF and a mutual fund is a bunch of stocks, right? Like all these make up a mutual fund or an ETF, right? And guys, this is what we need to teach our kids. They need to learn this. Our kids are throwing away their money, right? So,
Mhm.
can people make money when a stock price go down?
Yes.
Like, remember I showed you guys um, that that chart, right? What we concentrate on right here is stocks going up in value, right?
Mm-hmm.
So when the poor man buys a stock and they wait, the stock price goes down, they cringe and they go, oh my God, my stock is down. I've lost like 30% of the value. But guess what the rich guy is doing because he knows more than we do?
He buying them low.
He's buying, no, he's buying something called options. Because when the market goes down, you can buy something called a put. If you feel the market is going to crash, you buy something called a put option. And when the price of your stock goes down, you're making money. So these guys on Wall Street make money whether the stock market goes up or it goes down. So if the market goes up and you have a stock that's going up, and if you bought those stocks, you're making money because your stock is going up. If you buy what's called a call option, you're making double money. If you buy what's called a put option, if your stock price goes down temporarily, you can also make money. And this is what we need to teach our children. So a put option allows you to make money when the price of a stock goes down, and a call option allows you to make money when a stock price goes up. So that's why these guys on Wall Street make $12 million a year. And we're making $60,000 if we're lucky, right?
Mhm.
Now, I'm not going to go into calls or puts because that's high-tech knowledge, but I just want to show you how the rich does it, right? And they say only 5% of us, 5% of people on planet Earth are rich. And super rich is only 1%. You know why? They know about options trading, right? They don't buy a stock and hold it forever to make their money. When stocks goes up, they're making money. When stock goes down, they're making money as well, right? So they're profiting when prices go down, and they're profiting when prices going up. So once your children start investing and you tell them about mutual funds and ETFs, and they see that putting their money in a savings account and a CD is a waste of time, after a few years, they're going to want to learn about options, right? Because they'll be interested and excited, right? So I've just talked very simply about different ways of investing in the stock market. So, I've recorded this and I'm going to give you a copy of this recording. And I want you to let your kids and their friends, watch this because I didn't really do it in a very complicated way. It was very simple the way I presented it, right? So anybody
Yes.
can understand it, right? Now,
Right.
let's talk about buying a house, right? A lot of people are afraid of buying a house. And in today's environment, the price of housing has gone out of reach. It's so expensive. Now, when you look at Canada, for example, Canada is one of the most expensive places in the world now to buy a house. If you don't have $1 million in Toronto, you can't buy a townhouse. It's crazy. And when people in Canada see the price of a house, for seniors at 155, they're breaking their necks to come down and buy one, right? Because it's so cheap. So when we look at buying a house, right? In my opinion, buying a house is the best investment choice. Many people are afraid of the obligation. Renting over the long term can become a risk. There are several opportunities in one's lifetime to invest in real estate. For example, in 2008, that was a great opportunity to buy a property but many people were scared because it's a market crash. So everybody's nervous, right? So they always say when people run away from something, that's the time to run towards it, right? Now, inflation is the best reason to invest in real estate because once a market crashes and you know you buy in and you wait, inflation takes over and the price of real estate always goes up, just like the stock market. All those lines and all those graphs that I show you, real estate behave in the exact same way. And all commodities, whether it's a mutual fund, an ETF, stocks, real estate, all go up in the long term. You just have to wait. If you can't afford it now, you wait until the market corrects because there's always a market correction, right? Remember I show you that graph? All those downturns, they're market correction. So in your lifetime, there will be several market corrections, and those corrections are called opportunities. Okay? So
Mhm.
when you buy a house during a crash, you're locking down price at that time. Okay? So I'm going to give you an example. I was in Western Canada, and in 2002, I moved from Western Canada, which is Alberta, back to Toronto, right?
Mhm.
And at that time, I moved from a cheaper market because I paid like 171 for my house out there in 1985, I think, 1995. And then I sold it for 199 and I came to Toronto and houses were like $500,000 downtown. And I'm thinking, oh my God, what did I do? I need to move back to Alberta, right? So I went out to the outskirts to a place called Ajax and I grudgingly bought a house for $282,000. I was like pissed. I thought, why am I paying so much money for a house? Right? So at that time, I was scared, but because I was in banking, I know housing is always a good long term investment.
Mhm.
Well, guess what my house is worth right now? $1.5 million. And 2 years ago, at the peak of the market, it was worth 2 million. That's
Mm.
called inflation. A loaf of bread in the 70s was 34 cents. Now it's 4.50. It's called inflation. And that is what's happened to mutual fund prices, ETF prices, stock prices, right? House
Mhm.
prices. Totally. Many houses in Florida were selling from 60 to 120,000 with mortgage payments of about $400 a month in 2010 and 2012. At that time, people were scared because, we look on TV and people were crying, oh my God, I've lost my job. I can't find a place to rent, all that kind of stuff. So that scares you, right? That
Mhm.
scares you. And the guy who invested $10,000, in 2006 and, or say 2000 and his money went to $20,000 and then the market crashed and now it's worth 10 again. He's talking, he's in your ears as well. And so you're scared. Now that prices have tripled and so have, have pretty much, some have pretty much doubled. Okay. So you cannot be fearful when a market crash. That is the opportunity. Okay. So what is the most obvious benefit of real estate? You have increase in value, right? When
Mhm.
you buy today, you're locking in today's price because even though price is high right now, 10 years from now, you're going to look back and go, oh my God, I can't believe this. My house is worth $3 million, right? You're
Mhm.
reducing the price escalation risk because once you're buying at 120, that's your purchase price. You're locking in that price, right? If
Mhm.
you buy a rental property, that is great retirement income that always increases over the long term. Because if you were to buy a rental property, say in 2010, right? And you are renting that property for, $500 a month, right?
Mhm.
Now you're renting that property for $2,000 a month, but you bought that property for $85,000 and your purchase price is always 85,000. It's not 280 like it is right now, right? So that's why whenever the market crash, guys, jump in. Jump in. Don't listen to anybody else. Put on your blindfold and jump right in, right?
Mhm.
Rental income is better than a government pension any day because that goes up with inflation. And even though government will tell you, yeah, we're indexing your pension and it goes up with inflation, good luck, right? The
Mhm.
average person in Canada now, their pension is about $1,000 a month. And a lot of our seniors are 70 years old, they have big mortgages, and they can't afford paying their mortgage, right? Because they missed a lot of opportunities earlier in their years. They were scared to jump in, right? So rental income is sometimes better than a private pension. You may be working at IBM for 30 years and your pension is $3,000 a month, right? May go up, but it's not going to go up more than, say, $10 a month, right? But you can have rental income double in 2, 3 years, right? Which is what's happening in Toronto right now. If you don't have like $3,000, $4,000 a month, you can't rent a house, right? It's crazy. So you find a lot of older people now are living in their children's basement, because they just can't afford it. Or, a lot of people who live in Toronto, for example, are moving out to the suburbs or moving to other provinces where, rent is cheaper, right? And you find a lot of people in South Florida now, they can't afford it anymore. I was talking to my sister-in-law down there, and she says, Jean, we're looking at moving to Georgia because the cost of insurance is ridiculous. Some people are paying $10,000 a year because of all the fraud that's going on down there, right? So you really have to own your cash flow. Once you own your cash flow, and this is the message we need to give to our young kids, those kids that are, 20 and 30s that are making, decent money. Once you start creating your cash flow, no one can take that away from you, right? There
Mhm.
are people who think that because they have government pension of $3,000, it can't be affected. Talk to someone who lives in Greece or Italy when they had that crisis, what was it, 10, 15 years ago, right? People, government went in and started taking people's money out of the banks to,
Oh,
to fund the, government pensions. The money dried up because the politicians were careless at managing people's money. So anything can happen at any time. We had a company in 2009, GM, in Oshawa. I manage a bank in Oshawa, RBC. GM almost went bankrupt. They were threatening to move GM back to the States. A lot of people lost their pensions. It was horrible, right? People started, their mortgages were in default. It was crazy. But guys, the people who owned rental properties and bought it when they're young and had a rental income, they weren't affected much because they had that second or third stream of income, right? And right now online, you hear a lot of people talking about passive cash flow, passive income. A lot of people have their Amazon stores, right? A lot of people are buying products and selling it online. People, we have to start thinking that way, and we have to start training our children to start thinking that way. Because you know what? A lot of us own houses, but our children are dumb and we're not teaching them. And therefore, when we get to retirement, we have a house that's paid off for, and our children are going to inherit it. Guess what do you think they're going to do once you die? They're going to sell that baby and they're going to start buying cars. Right? So we have to teach them the value of money. They need to learn it, right? And we need to teach them that. Okay. So when we talk about cash flow, a lot of people have side hustles. I have some cousins in Florida, in Miami, that have made millions from having Amazon stores, and they teach people how to set up Amazon stores. Um, some people have their full-time job and they're part-time realtors. They're selling house, they're hustling. Some of them are part-time mortgage brokers, right? They have Amazon stores. Some young people, I know some young guys up here, they have vending machines. You see them in the evening after their jobs, they go and they stock their vending machines, put them in subways and different, malls and stuff like that. They're making their money, right? And with the money they make, they're buying more vending machines. So after a while, they have 5 vending machines, right? So a business that can give you ownership on your cash flow is totally, totally awesome. Now, I wish my nephew was here, Anisha, because I was going to give him some homework.
He told me I have to send him over everything. He was like, make sure you get everything for me.
So, when we talk about the different investment strategies, such as the mutual funds, the ETFs, the stock, right? All those plans, you can have them as retirement plans, right? So you have heard about your IRA, your Roth IRA, all these plans. I was going to give him homework to research all these things because I'm not going to go and discuss all these things, right? But the government has a ton of products that you can deposit money to, their retirement plans, the IRA plan. We call them RSPs up here, retirement savings plans. You put $1,000 into a retirement savings plan, and if you're in a 30% tax bracket, you get back 30% of it. Why not take advantage of it? A lot of people don't even know that these things exist. Take advantage of it. If the government is going to give you a 30% return, do it. You can't go wrong. Some in Canada, we can put monies in a retirement plan and borrow it at zero rate of return, zero interest, and buy a house, right? So we need to encourage our kids to learn about these different plans. All right. So I would like everyone to look at all these different retirement plans and research them, see how they can benefit you. Now, we want to talk about disciplined savings. We have to teach our children to save in a disciplined manner. Save a little at a time. A lot of people now, you go on Facebook and all these different mediums on social media, and you find a lot of people are advertising these overnight success, Bitcoin and mining and all that nonsense. Let me just tell you about a quick story. One of my clients called me once and she said, Jean, she was in tears. She says, I got to borrow $40,000. I said, what's wrong? She said, my stupid son went online and some guy was talking about Bitcoin mining and he borrowed my money and opened an account with them. He put in $5,000 and in no time he doubled his money. And all this was online, right? He couldn't see it or feel it. He's just seeing statements online and he got excited and he kept borrowing my money. And now we're up to $40,000. And this morning he went on and there was no such company. Money gone. A lot of people have lost in these things. A lot of people, right? So the best thing to do is to discipline yourself and teach the children how to invest in one of these products that we've talked about and save some money. If you go on any bank's website, they have retirement savings calculators. Here is one that I picked up on RBC. If you plan to retire in 20 years, you save $300 a month. Your rate of return, say 6%, and very conservative. Over 20 years, just saving that amount on a monthly basis, you could have $138,000. Just saving in a mutual fund or an ETF, right? You can encourage the children to do that because it's not rocket science. It's just disciplined savings. Remember what I told you about my TD stock that I bought? In 2001, I borrowed $2,900 because at that time I was a single parent, guys. I didn't have money. I was living paycheck to paycheck. I borrowed TD stock was $29. I borrowed $2,900. I bought 100 shares. And in 2016, that 2,900 became $42,000. This is the same method. We need to teach our children this. Now, let's talk about certain priorities, right? How much money do Black women spend on fake hair? A ton. Approximately $7 billion is spent on hair care in Africa, leading to companies targeting the continent. Reuters report that Africans spent approximately $7 billion on hair in 2014, and global brands are taking notice. Despite their limited financial resources, Africans spend $7 billion on hair in 2014. So, Anisha, what do you want to buy your ETF in or your stock in?
Hair.
There you go, right? There you go. And to me, this sister looks just as good as this sister in the middle or this sister in the right, right? But we're spending a lot of money and enriching everybody else except our own. The Chinese market, the Jewish market, their money goes around in their community 6, 7, 8 times. In our community, hardly once. All our money goes to support people in different communities, right? By 2023, the global market for hair wigs and extension is expected to reach more than $10 billion. This is money from poor people, right? Exactly what does that mean to you? If we were to put back $10 billion back into the Black community, what would be the outcome, right? We would be amazing. You know, I heard someone said to me once, you know, the average Black man, and don't take this the wrong way, this is not a knock. The average Black man is everybody's baby daddy. They mind kids in every community except their own, right? And in a way, it's true because this is the dude that's getting all the money from all those hair weaves and all those, you know, Nike running shoes that we're paying $2,700 for. Look how many cars this guy has, right? And his kids go to private school. And most of our people live in the ghetto and we're shooting each other. And we have talent, guys. We have talent. You would not believe the talent we have in our community. So we need to teach our children how to invest their money. They can invest $25 a month. It doesn't matter. It teaches once they have the desire to learn and they want more, guess what? It'll come. It will come, right? So where does your money go? If you love yourself, you will pay yourself first. This is a message we need to give to our young ones. We shouldn't be giving money to Jeff Bezos at Amazon, not Bill Gates at Microsoft, not Elon Musk with Tesla, right? And the list goes on and on and on. Every time you make money, you invest money, 10 to 30% of it can, every time you make money, invest. Yeah, every time you make money, you earn money, your paycheck, invest 10 to 30% of it if you can before you pay a bill. Many kids live at home. Many kids, my kids don't hardly pay rent. I just started charging them $300 a month just so that they can be responsible, right? But many children do not even pay rent. And before they start spending it on nonsense, encourage them, guys. Put 10% of your money in a mutual fund, in an ETF, in a stock. Do it, right?
Mm-hmm.
So all this is by design. We have to be smart. We have to keep some of our money for ourselves, right? So I have a little trivia here, right? What was the Apple stock worth in 1986? We know Apple iPhone, right? One that you pay $1,500 for. I've never bought one because I refuse to spend so much money on a phone, right? Now, this is a platform shoes that I bought in 1986 for $700, right? Now, do you know what the price of Apple? I Googled this today. The closing price for Apple stock, the closing price for Apple stock in April 1986 was 14 cents. Okay? The closing price for Apple stock in 1986 was 14 cents. So I know if I give a kid $700 in 1986, most of them, right? Females would want to buy this, I think it was Louis Vuitton shoe for $700. But the kid that you show this presentation to will think, oh, I remember Jean was talking about buying stocks. So I'm going to buy this stock, right? We're going back to 1986 now. For 14 cents, my $700, I'm going to buy 5,000 Apple stocks with my 700 bucks in 1986. So that Apple stock today, my friends, is worth $180.57, which is $902,850 today. So the person, the kid that made the decision to buy the platform shoes versus the Apple shares at that very low price will have $1 million today.
Oh, wow.
Right? And, you know, Lakeisha, who wanted to go, hey, I look great, look at me. He has a damn old platform shoes. And we ain't wearing that today anymore. We're wearing Louis Vuitton 5-inch spikes, right? So this is a lesson we need to teach our children. Learn about investing. Make good investment decision. End up with $1 million, not some old platform shoes. Okay?
Mm-hmm.
So I want to ask you a question. So Anisha,
Mm-hmm.
remember we talked about the TD stock that I bought, right?
Mm-hmm.
I bought it for $2,900 because it was $29 and I bought 100 shares. So 100 times 29 is $2,900. In 2016, the stock price went to $57.86. So those 100 shares moved from $2,900 to $5,786. But what did I tell you that the stock was worth? My portfolio was worth $42,000, right?
Mhm.
And the reason why it was worth so much is because I was investing my dividends over all those years. And it's not a long time. It's from 2001 to 2016, 15 years. I'm still alive, right?
Mm-hmm.
So this stock that this kid bought in 1986 for 14 cents, bought 5,000. Do you really think it's worth $902,000 today? What do you think it's really worth when we think about the dividends?
Maybe $2 million or so.
$3-4 million. That's the beauty of compounding rate of return and dividends. This, guys, is what we need to teach our children. They need to learn this. Because you know what? When we have our houses, a lot of people have houses now, they're 70 years old, their house is fully paid off for, they have children that are going to inherit it, but those children are playing video games. They're dumb. We need to take them off the computer and teach them this stuff. So no one can fool them, right? A lot of people are losing money right now because they're not making wise decisions. I'm a mortgage broker, and if I tell you some stories that are happening now to some of our 50-year-old, 60-year-old mothers in Toronto, you know, they buy a house, they paid off 50% of equity in it, and some mortgage broker, some crooked real estate agent says, hey, you can borrow some money and buy 2 more houses. And they give them a private mortgage. And as we speak right now, a lot of them have lost those 2 houses and about to lose their principal residence that they live in simply because they never pick up a book, right? So if you know what you're doing, no one can fool you. And if we teach our children, we may not know what it takes to teach our children because we don't have the knowledge, but you know me, and you know that I have the knowledge, and I'm willing to teach your children, right? And the reason I'm doing this right now, Anisha, is because I came over one day to visit you, and I was in the backyard, and your son came out to me and he says, Auntie, would you like a Sprite? Auntie, I got you. I got you. You know? And I said, wow, you know, he's already adopted me as an aunt. And as an aunt, I have knowledge. I can teach this kid. And that's what I'm doing tonight. That's what I'm doing tonight. So I'm recording this, guys, and I would really like you to really have them sit down, invite their friends over, and sit down and watch this because I've broken it down simple for them to understand it because the future of our children is really important to me. So I want to thank you guys for taking the time out to sit with me and you know, spending the last hour and learning a little bit about investing. What questions do you have? Was I clear in everything?
Yeah,
Yes,
you're
Jean, this is
really
Vicky. You was very clear. I did just
Good.
have one question. So
Yes.
when you have stock and they
Mhm.
send you a dividend check, is that check you should not take and just have it reinvested? Is that what you're supposed to do?
Yes, when you buy a stock, right? Why take a dividend check, you know, $13? Why? You know, you don't need it.
Right.
When you go and you open your stock account, they will say, okay, you've just bought 100 stock of Bank of America. Would you like to invest your dividends? Say yes, because it's called a DRIP. They'll say, would you like drip dividend reinvestment plan? Yes, I would like it. So every time my dividend pays out, it could be once a year or twice a year, reinvest it because that's why I made $42,000 versus $5,786.
Mm.
Absolutely.
Oh,
I was
okay.
a drip in Exxon.
Yes.
Even though I don't have a lot of money to put on it, but I do. I have a Exxon drip.
Yeah, there you go. There you go, my friend. I'm telling you. And over the
Zero.
long term, over the long
Exxon
term,
Xerox.
huh?
Not Exxon, but Xerox.
Yeah, there you go. You know, so, you know, that's what you should do, guys. You know, it's really important that we teach our young ones what to do, you know. I've taught a lot of people here in Canada, you know, not in Florida as much. You don't have houses with basements. Here in Canada, we have houses with basements. And a lot of people are struggling paying their mortgage and they have equity in their house. And what I'm encouraging them to do is borrow $50,000. Fix your basement, put a 2-bedroom apartment down there, rent it for $1,650. You know, teach your children that. That's money. You know what that is over a period. You could use that and pay your mortgage and live free, you know? So it's just a
So
matter of knowing strategies, what to
yeah,
do. And we need to
uh,
teach our children
Jean,
this.
I have one more question. How
Yes.
how how do you choose or know which stock to purchase? Are you just kind of like get one, find one, or pick one, or
That is why I said, whenever you're just starting out, I don't expect you to go and buy a stock. I expect I expect you to buy a mutual fund or an ETF, right?
Okay.
Right now, ETFs are, remember I said ETFs can be in the technology sector. ETFs can be in the healthcare sector. ETF can be in the technology robotics. Robotics is going to be a big thing in the future. So you can buy a robotics ETF, right? If you feel that they're going to be curing cancer or whatever, right now, Ozempic is fantastic. A lot of people are using it now to lose weight. So you may go, there's opportunity in the technology sector. I'm going to buy QQQ, right? What you can do is go online and Google technology ETF, symbols for technology ETF. You'll see QQQ. Here in Canada, I buy HXQ, Horizons, ETF. That's a technology stock, right? There is also, remember that chart I show you? It's good when you're doing that. My suggestion is to buy something on the S&P stock index. You see that blue line here? That represents the S&P 500. Do you know that since the S&P 500 started, it's earned 10% annual every year? Like not every year, but on an average return, 10%. Do you know how powerful that is? Very powerful, very powerful. So if you were to buy an ETF in Canada, I buy something called XIU, right? That is the S&P TSX stock market, right? That's an ETF that is based on all the stocks in the S&P 500. So if you buy say you buy Home Depot stock, and Home Depot has a bad year and you buy it at 280 and it has a bad year or something goes wrong with it and it loses 30% of your value, you're losing 30% of, say, if you have invested $10,000, you're losing temporarily, that is, because in the long term, it's going to go back up. But you're going to lose 30%, $3,000, right? If you were to cash it out. But if you buy an ETF and the ETF has 700 companies, if Home Depot was one of the stocks, that's not going to affect the value of the fund. Minimal, right? Because what's the fund? Say if you have a mutual fund, right? Remember, I was creating this mutual fund before COVID. If I create a mutual fund with all these 5 stocks in there, and if the price of eggs goes down, but all these other one goes up, you're still making a positive return. So what a mutual fund and an ETF does is balance out your risk, right? But if you have one stock and the company has a bad experience because something happened, you can lose value in that overnight. Whereas if you're in a mutual fund, all the companies in the mutual fund will have to go bankrupt before you lose money totally to zero. So you see what I mean? Do you understand? Do you understand risk better now?
Yes.
That's right. It's a better risk buying a mutual fund, buying an ETF than buying a stock. Right? Now, some people may say, look, I'm going to buy some cruise line stocks because they're still struggling. They haven't gone back, they're still struggling from COVID, right? So that could be a good entertainment stock. That could be a good one, right?
Okay.
A lot of restaurants, they were shut down for so long, that could be a good one. A stock that I really like? Dollarama in Canada. It's a dollar store, right? That stock has doubled in the last few, 3 years. I bought it at 40. It's now like going up to $90 because in tough times, people shop at dollar store.
Yeah.
Right? But you have to be careful because you will, say, okay, I'm going to buy Royal Caribbean because I know they're going to do well, right? But suppose Royal Caribbean has a brand new ship, right? And they bought this brand new ship and they're doing well. And all of a sudden it hits a iceberg and there's bad news in the media. You hear it on the news. And all of a sudden people get scared. They sell their Royal Caribbean stocks, not because Royal Caribbean doesn't have a good future, but something happened. News out there. It's risky. People are scared. They're selling their stock. You could lose a lot of money. But if you're in an ETF, the risk is less, right? So
Right.
you may think a stock is good, but it may not do well. So that's my, until you get more experience, more, sophisticated in studying stocks, I would stick to mutual funds and ETFs.
Okay.
Okay. Okay.
What other questions do you have?
You're gonna send this recording to Anisha?
Yes, I will.
Okay,
Absolutely.
great. Great.
Okay. All right. So I want to say thank you again and have a good evening. I hope my presentation was insightful and helpful. Please pass this information on to the young adults, please. Okay?
Okay. All right,
Okay.
Jean, thank you
Thank
so
you so
much.
much. Have a good
Thank-
evening. Bye-bye.
You too. Bye-bye.
Hi, Michelle.
Hi.
I'll call you back.
Okay, love you.
Okay.